We won't get this session started. Before we start, I just want to let you know, anytime if you have any questions, folks, you can either type it in the chat or you can try to raise your virtual hand. If you look at the chat session, there is a option where you can raise your hand and you can unmute yourself and ask a question either way. And you can ask them during the class and I'll respond to them. So let's get this started and share. All right. Can everybody see the PowerPoint? Yes. Okay. All right. Good morning, everybody. Welcome to the 2020 Fall Loan Boot Camp with the Tri-County Association of Realtors. My name is Eric Wu. I am a mortgage broker associate with the McLeod Associates Group. Usually, the broker owner, Mia McLeod, will be the one teaching this mortgage boot camp, but I'm kind of stepping in today to kind of fill in the role. I've done this class for quite a bit now. I started in 2016 when I starting to teaching the class at Chapman University. And once I got on board with McLeod, she kind of wanted me to take over and teach this loan boot camp to realtors. And that's what we're going to talk about. It will be mostly about mortgages, some of the details, loan requirements, some of the different loan programs, and also what you need to know as realtors, some of the changes in the lending world that has been affected by the COVID-19. Some of them are drastic, some of them are minor, but it's good to know to have that information in hand. So when you take your client out showing houses, you can be equipped to get them ready and increase your odds of winning the bid. So today's session really consists of two main sessions. Basically, we're talking about the ABCs, the basics of the loan program. And also, I'm going to talk into some of the specific loan programs that we have as well. Again, some of the programs that are still available, some of them may not be as readily available as before. But I will be diving into those programs as well. Okay. All right. So let's get started. Let's start with the ABCs of the loan. Now, when you take your client out shopping, you probably, as a seasoned realtor or as an up-and-coming realtor, you should know that before you take your clients out, they need to get some sort of pre-qualification or pre-approval. But with that said, it is important to know the distinction. There's actually quite a bit of difference you want to be aware of between pre-qualification and pre-approval. Quite frankly, let's start with pre-qualification. What it really comes down to is pre-qualification is simply a general assessment of the client's situation. Basically, the evaluation is done verbally with no documents verified. So if your client talks to a lender over the phone or meet in person, if they just verbally exchange the information without any document verification, that in essence is only considered pre-qualification. Whereas a pre-approval, it goes more detail. Now, instead of just talking about the number, you're actually providing and verifying the numbers. You're talking about collecting a set of documents. And it's just, as you can see on the PowerPoint, there's a list of documents typically the lender will collect for an official pre-approval. We're talking about, first and foremost, you fill a loan application. You will also need a borrower authorization to check client's credit score. If the clients are a wage earner, then we'll take a look at their income information, such as the most recent pay stubs, the most recent W-2s, as well as the most recent tax returns. Also, in terms of assets for the down payment and also the closing costs, you will need the most recent asset statement, whether it's bank statement, 401k, retirement accounts. If they have gift funds, you want to ideally get a copy of the donor's gift fund bank statement as well. So that's for wage earners. Now, what I didn't put in is self-employment. This is one thing you want to be aware of nowadays, especially this this COVID environment. There's more requirement for the self-employed earners. In the past, you simply need 2 years of tax returns, federal tax return that is, and then you just needed like maybe a up-to-date unaudited profit and loss statement, and that information in itself is sufficient for self-employed. But nowadays, because of COVID, lenders are very worried that the self-employed folks might not be able to sustain their income, so they are looking more in depth as to their current business status. So in addition to the tax returns and also the profit and loss statements, they will be asking um, the client to provide updated bank statement to show any sort of revenue deposited into a bank's account to show that they are in fact still operating. Um, so just kind of keep that in mind with your self-employed borrower, in that their requirement is much more strict given this COVID environment. Next, DU approval. DU stands for desktop underwriting, is one form of an automated underwriting system. Uh, Typically, when your clients go through the pre-approval with a lender, they collect all the documents through the eyes of the lender, or the loan officer. They deem that this client is pre-qualified or is pre-approved. But if you want to take one step further to add further assurance that your client is truly qualified, without quite yet getting the loan to an underwriter, this would be the intermediary step, and that's a DU, which is an automated underwriting system. What it does is the loan officer would input all the information that he gathered, the financial, the credit information, into the loan originating system, and they will run this automatic loan automated underwriting system. And if this underwriting system gives it approval, you can safely say that this client is about 99% truly approved for mortgage. Why is this more important now? Why you should know this? If you are out there looking for showing properties, two things. Some of the listings, because they're so overwhelmed with showings these days, they want to filter out the showing right away. So some of the listing agent right off the bat will ask for a pre-approval as well as a approval of the client before you even show the property. Some listing agent those go to that extreme to filter out the potential buyers. But at the very least, if you get to a point where your clients want to submit an offer, nowadays more so than ever, if you want to have a chance to win that offer, you need to show your clients are truly approved. And one of the requirements that the listing agent will ask for, well, even if you don't ask for, you should consider providing it, is this DU approval from your client's lender. This gives the listing agent assurance that, hey, my borrower is not only sincere to submit an offer, they're also truly approved. So again, having a DU approval as part of your offering package just further increases your chances of getting your loan or your offer accepted. Cross qualification. This is something that quite a few listing agents would require as well. Nowadays, what's going to happen is, in order from the listing side, they felt like in order to have another additional layer to ensure that the borrower is truly qualified and there's no hiccup during the transaction, they want to be able to how do I say this? They want their own in-house lenders to verify that the borrower is truly qualified. Now, here's the thing: some buyers and buyers agent felt like this is unnecessary. There are even fear that the the in-house or the seller lender might be poaching the client for their lending services. If your client has already been pre-approved, one way to kind of avoid the hassle of your clients repeating the work is simply have your lender contact the seller's lender directly. They both speak the same lending language. It will be easier to get qualified. But just keep that in mind, given this current environment. For a lot of instances, for sellers, it's not that they want their lenders to get your client's business. It's just for their own peace of mind. They really want to ensure that there's no issue with the buyer, and everything can go as smoothly during the escrow. So just kind of be on the lookout when the seller look for cross qualification. Now, in terms of what type of lenders your client could be working with, this is for your own information. I'm sure most of you are aware of the differences, but it's kind of for those who are not sure of it. It's I can just kind of quickly define it so again it's for your own information purposes. It's good to know that what kind of lender your clients are working with. In general, the type of lenders are direct lenders or mortgage brokers. Direct lenders are lenders that basically fund their own loans and have all the operation done in-house. um, one of the example of a direct lender, it could be your depository lender such as Wells Fargo, Chase, Bank of America, etc. When your client walk into a branch and they work directly with a lender, those are direct lenders. They have in-house um, processors, underwriters. Although they might not be at the same location. They might be out of state, but again, all the process is still done in-house from a direct lender. Another example of a direct lender will be like an online lender. I'm pretty sure you guys have heard of Quicken Loans or perhaps even Loan Depot. Those lenders would be considered a direct lender as well, even though they don't have a physical office per se. All the operation is done in-house, and that's also considered a direct lender. Somebody have a question? No? Okay. All right. Oh yeah. Now, in terms of operation and also maybe the rates, before the distinction is that direct lenders, because they have their in-house. Oh, I'm sorry. Before I talk about the differences, let's talk about mortgage broker. Mortgage broker is a case where they don't have their internal system. They don't have internal underwriters and processors and whatnot. What they do is they don't work for a lender. They work with multiple lenders. So they have the flexibility to kind of have access to multiple loan programs. Most of the time, though, the internal process of the processing and underwriting that's being done, you're working with the respective wholesale lender that the broker work with. So that would be the distinction, is that there is no in-house processing per se. The processing is sort of outsourced with the respective wholesale lender that the broker work with. Okay, now let's talk about the differences between a direct lender and a mortgage broker. The difference is the difference gap is actually shrunk than before. In the past, the difference would be direct lender process would be more efficient because everything is done in-house. They're considered a retail lender, so again, every process from start A to Z will be done in-house. On the flip side, though, in general retail rates are typically a bit higher. Um, anywhere between an eighth, maybe to a quarter, or even more. So that's kind of a trade-off. Broker side, the distinction they had before is that um, you're working with wholesale lenders, and you're getting wholesale rates. If you can think of interest rate as
commodity. Morning, just again.
Oh, yeah. The difference between the broker.
Fisher from which company?
Oh, hold on. Somebody is on. Let me see here. If you haven't done so, you can mute your screen. I mean, mute your audio. Let me see if I have access to it. Laura.
Okay, not right now yet. Yeah, okay. If I do,
sorry guys, I'm not the host, so I don't have the opportunity.
Right. Thank you. Yeah. Bye bye.
All right. Yeah, if you guys can, if you can just mute your audio for now, so while we go through this this boot camp. Thank you. All right, so we're talking about brokers. The advantage that broker used to have is that they work with wholesale lenders, so in essence, they do have a lower interest rate. If you can think of interest rate as a commodity in terms of retail versus wholesale, when you work with wholesale, you get the lower rate or lower price. And so that's the advantage that a broker has. But in exchange, though, the process would be a bit more slower than retail because you don't have the in-house processing. So it's the process will be a bit slower for direct lender. But that was before. Nowadays, the differences are much more narrower. Direct lenders now, their rates are much more on the even level versus mortgage broker. And on the mortgage broker side, the wholesale lenders that they work with, their internal processing is much more efficient as well. Like you can have direct access to underwriters and processors, just like the direct lenders. So again, the gap is narrower between the direct lender and mortgage broker. And at the end of the day, it's been more beneficial to you realtors and your clients. All right. Okay, once you figure out what type of lender that your client work with, and when you go through an escrow, this is something, again, just for your own information. Once they go through a loan approval process, when you're in escrow, once the loan is approved, these are the list of common requirements that the underwriter will be asking for. There's really no way around it. Like we just highlight some of the documents that we typically see from most of our clients. So if your clients get a head start in preparing for this, it only help out the process when you're in escrow. One of the biggest, if not the most important conditions or requirement now that lenders asking for is verification of employment. Due to the pandemic, from the lender's perspective, their biggest fear is that the client will not have a stable job or be losing their job during the transaction, and that they won't be able to pay the mortgages. So that's why verification employment, in the past, it's only done once, maybe twice during the transaction, but nowadays it's being done multiple times. It's being done at the beginning of the escrow, middle of the escrow, and even prior to funding. The lender will be calling the employer just to verify that, hey, the clients are still employed. So that's just something to keep in mind for your borrower. Letter of explanation, this could be for various reasons. It could be done because of address, an old address that showed on the credit report, and the lender wants to make sure that they don't own that address, that property. It could be name variations. It could be if there's an employment gap, they want to know why, right? So there could be various information, but typically some sort of letter of explanation is needed for whatever reason. Credit supplements, if they have to pay off certain debts in order to qualify for a loan, the lender will be asking for additional supplemental documents to show that they pay out the personal debts. Proof of homeowner insurance. Now, like when you buy a home without a mortgage, you as a homeowner, you're not required to get a homeowner insurance, but for applying for mortgage purposes, it is absolutely needed. So just again, at the beginning of the process, just remind your client to provide a homeowner insurance agent or broker contact information so that the lender can coordinate with them to get an insurance quote, whatnot. Income documents, like I mentioned before, if you're wage earners, they're going to constantly asking for updated income documents to make sure that your clients are still employed. And as I mentioned before, even for self-employed earners, they're going to ask more information just to make sure that they're going to need they're up to date and the business still intact. So appraisals. Okay, let's bring it to the next screen. Appraisals. These are minor things, but these minor things could, if it's not taken care of ahead of times, could cause delays in loan process. And what I mean by that is when your clients already order appraisal during the loan process, check with the listing agent to make sure they have all of these lined up or set in their home: smoke detectors, carbon monoxide monitor, and also the heater is properly strapped. Because what's going to happen is if any of these items are missing in the appraisal, it's going to cause a delay in that the appraisers will not certify or give a finalized appraisal report. They're going to give you a report, but they're going to say like, hey, the report's not finalized until these items are provided at home. And what's going to happen is it's going to take sellers maybe a couple of days to put this up, and then it requires the appraiser to pay another visit to the property to verify this. So that in itself, if you miss any of this item, you can expect that the escrow is going to be delayed at least a week, if not longer, just because one of these items are missing. So be prepared. Like when your client is ready to order a appraisal, make sure all these are taken care of by the listing agent. So, all right. We want the loan process to be as smooth as possible. But what are the things that we can remind our clients to be on the lookout for to avoid any hiccups or delays. And these are the common items that you can remind. Well, your lenders should be reminding your clients about these items to avoid. But as a realtor, if you know these potential pitfalls, it doesn't hurt to kind of offer a second voice to remind your clients as well. So here's some of the things. Number one thing is just buying a car, but you can categorize just buying anything that requires a large debt, right? Buying a car, buying the furniture beforehand. Though, any large items that put a large debt on your credit card or you requires you to take out a new debt or new credit line, it could potentially affect the qualification of the loan. Depositing money that cannot be sourced. This is one of the biggest frustration of some of the homeowners, in that they have the funds, but it cannot be used. A lot of instance from my experience is where clients didn't do the proper due diligence of getting pre-approved ahead of times, and that they just think that as long as there's the money, they can use it at any time, but not knowing the fact that these funds has to be sourced. So a lot of times when they open escrow, they got the bad news like, hey, the money was not in their asset account for 2 months, and they end up cannot use it, which sucks, right? So you want to make sure that the funds for your client is properly sourced so they can be used. Quitting jobs during the escrow period, you would think that would be kind of an obvious things to avoid, but there are clients who think that as long as they're in escrow, they can do whatever they want with their job situation, which is not the case. You just have to remind them like, hey, they have to maintain their employment status throughout the escrow process. Taking on new debts, again, kind of goes along with buying the cars. Switching jobs. Okay, here's an interesting aspect. In an ideal situation, if your clients have to switch job, you either want them to do it before or after the escrow. Now, does it kill the deal if they switch jobs during the escrow? The answer is no, but it probably will prolong the process, because if your client switch job during escrow, the lender will need some sort of additional evidence to show that they have stability with their new job position, right? So first and foremost, they're going to ask for a job offer letter to make sure that the job switch is legitimate. And number two, they're going to ask for updated pay stub from the new lenders. For the new employers, whether it could be just simple as one pay stub, but it could be asking for 30 days. But regardless, if they switch jobs during escrow, and that a pay stub is needed, you can bank on the fact that that's going to prolong the escrow process. So, and let me see here. Poor communications. That kind of goes without saying, right? In order to make sure that we close escrow on time, it doesn't just fall on the lenders, right? It falls on everybody, the buyers, the escrow companies, the agents, whatnot. Everybody's in it together. So we want to make sure we have open lines of communication with all parties to ensure that we can close the deal on time. Any questions so far? Any questions? Okay. All right, let's move on. Okay. Now let's go back to the pre-approval process. The first part, I'm really kind of explain what the lending side looks like during the escrow. Now I want to, in a way, kind of take you to the borrower side as to what they need to do to be able to qualify for a mortgage. I try to simplify this as simple as possible. In general, the lenders, in terms of providing the client with a mortgage, they look at these three major categories, and I simplify them as the 3 C's, which is credit, collateral. Collateral means that your down payment, your source, your ability to have assets for the down payment and closing costs, and also your capacity, basically how much you earn versus how much you owe. First, let's take a look at credit. What does my FICO, from a consumer perspective, what does my FICO need to be? Most of you know this, but for those who don't, you do not need to have exceptional credit score to apply for a mortgage. You simply need to have adequate credit scores. which when I talk about loan programs later on, I'll talk about each what the minimum credit score is for each loan program. But as long as your clients have low 600 or in some cases even high 500 credit score, there's an opportunity for them to qualify for a mortgage. Just again, just know that your client does not need to have stellar credit in order to qualify for mortgage. Now, let's talk about collateral. Do I need to have a lot of money to buy a home? The answer is no. Again, with us as real estate professionals, we know that 20% down to buy a home is not necessarily the case. We know that there are other options with lower down payment, but surprisingly, a lot of clients do not know that. Home buying consumers, especially first-time home buyer, they are not aware of it. So when you meet with prospective home buyer, especially first-time home buyer, let them know that 20% is not a requirement. It can be little as 5, 3.5, or even 3%. Or in some instances, they don't need a down payment because there are down payment assistance programs available for them. So which I will touch up about later on. But yeah, this is a big misnomer. It's obvious for a real estate professional, but I can't stress this enough. A great deal of first-time home buyers, they are not aware of this. So to help you kind of gain more customer base, if you will, let them know that about those low down payment programs available for them. So another question is the income. What if I make good money but have a lot of debt? Do they consider a balance on my debt or my monthly obligation? The answer is yes. A lot of clients assume that they have high income, they automatically qualify for the high loan amounts that they think they should qualify. But that's not entirely the case. You can have any income you want, but on the flip side, if you have a great deal of personal debt, guess what? It's going to greatly affect your clients. Whether it's personal, in general, what kind of debt are we talking about that could affect a client's qualification? Simply put, as a general rule, it can expand beyond that, but as a general rule, basically any debt that showed up on the credit report is a debt that we have to concern about. Anything that does not show up, like technically it's not official debt, so we don't have to worry about. I mean, there are some exceptions, like maybe a child support or alimony, right? That does not show up. But if a client indicated they're divorced, then we're going to ask for a divorce decree, and then we're going to, that's going to show up with the child support and alimony, which does not show up on the credit report, which we'll have to take in consideration. But in general, in terms of what kind of debt we have to worry about for a client, basically anything that shows up on their credit report. All right. So far, so good. Any questions? My apologies. I can't see the chat. Hold on a second. Let me see. Small. Okay. Okay. All right. So now I'm going to talking to specifically some of the loans that are readily available in the current market. It's a good idea for you as realtors to know what type of loans are available. In general, you always if you want a client to know what the loan program they're available or qualify for, you would kind of pass it on to the lender to have that discussion. But for your own information or knowledge purposes, it doesn't hurt to be knowledgeable about the current loan program available for your clients. So let's get into it. Here are some of the most common loan programs. The first one is conventional loan. This probably dominate more than this is dominate more than half of the mortgage market. Greatly, yeah. This is your standard Fannie Mae, Freddie Mac loans, and here are some of the characteristics. Like as you can see, you do not need a high credit score to qualify for conventional loan. It could be as low as 620, and you can still qualify for conventional loan. The capacity, the debt to income ratio, nowadays rather generous. Back in the day, it could be 41, 43, or 45%, but now it is generous in that as if your client's total debt, housing, personal debt, does not exceed half of their monthly income, then they qualify for a loan, conventional loan. As for collateral, It could be as low as 3%. Now, I should have put an asterisk on that 3% down payment for conventional loan. That particular option is only available for first-time home buyers. If your client is a non-first-time home buyer, then the down payment percentage goes up to 5%. So, but again, it's still relatively low. Like I mentioned before, you do not need 20% down to apply for a conventional loan. Now, some of the benefits for conventional loan is that right now in this current market, conventional loan does have the lowest interest rate. Prior to this year, the COVID environment and whatnot, the jumbo loan actually has the lowest interest rate, which I'll talk about later. But now, with our current environment, the rates just kept getting lower and lower. It right now pretty much is conventional loan is the loan that has the lowest interest rate. This loan is pretty much available through any lenders, whether it's a direct lender, whether it's a online lender, whether it's a mortgage broker. Just I would say everybody, any bank or lender that offers loan has a conventional loan that can offer. So your clients will have a lot of options. This loan can be used for primary home. It can be used for a second home or vacation home, or it can be used to purchase an investment property. And that's not the case for the other loans, which I'll talk about later. Some of the negative effects. It has a higher credit standards versus a FHA or VA loan. Again, I will talk about those loans later on. Even though the minimum barrier is still low, but it is higher compared to the other loan. The income verification is very thorough, especially given the current environment. The lenders, they want to make sure that the clients are truly qualified for this mortgage. Mortgage insurance. In some instances, when you put down less than 20%, the clients will be required to pay mortgage insurance, which is another layer of housing expense they had to pay for. And also loan limits. It is not unlimited. There are loan limits set at each counties. Right now, in all county, it's set at $510,400. So you can be sure that regardless of what county you are in the U.S., the minimum loan amount they can borrow for is $510,000. Now, in some of the high cost living areas, such as Orange County or Los Angeles, they can have a higher loan limit because they have high cost living. So in those areas, the loan limit can be increased up to $765,000 and $600,000. Yeah, I put an asterisk on those loan limit because although it has not been announced yet, there is a good chance that these loan limit will be increasing in the next by next year. What happened is these loan limits are a reflection of the average market price in the U.S. And for the last 5 years, the market price has been increasing, and as a result, the conventional loan lenders, they have been increasing the loan limits. Again, as you can tell, most of you, if you're out there representing your client, you'll notice that the market is just on fire right now. You have to bid over, you have to bid way over what the seller's asking for in order to have a chance to win the offer. Now, as a result of that, the price is higher. And again, although they haven't announced it yet, given by the reason that they will increase the loan limit, you can bet on the fact that there's a good chance the loan limit will be increasing. As to what amount, that's to be determined. So, all right, so that's conventional loan. FHA, if your clients have a low, in general for FHA, if your clients have low credit score or not enough for down payment, then FHA loan would be a good starting point for them. Let's take a look. In general, FHA loan, for all lenders, it starts at 580, but there are lenders that are willing to lend FHA loan at even lower credit score. Some can be as low as a low 500, but just for simplicity purposes, let's just start with 580, but know that it can be lower. Capacity, the debt to income ratio, it could be, it is higher than conventional loan. It can potentially go out to 55% debt to income ratio. Collateral, at the minimum for FHA, it can be 3.5. You only have to put down 3.5% or less, if your clients tap into the down payment assistance program. One of the benefits of FHA, again, just like conventional loan, Right now, this program is also have probably the lowest interest rate of all the loan programs available. It has a loan down. It has a low down payment requirement, and the income it is a bit more flexible than conventional. Although now there's not that much. The cons, the downside of FHA is, regardless of how much down payment you're putting down, there will be mortgage insurance. It doesn't matter if you put more than 20% down. If you put 25, 30, or 40% down. If you use an FHA loan, there will be mortgage insurance. And there's two types of mortgage insurance. There is the monthly mortgage insurance. They have to pay along with the mortgage payment. And there also has to be a upfront mortgage insurance they have to pay. Generally speaking, the clients have the option of adding that onto the loan amount or paying them upfront out of pocket. But from my experience, most part, the client just prefer to add that to the loan amount, basically financing the upfront mortgage insurance. It has a thorough evaluation process, just like a conventional, very similar to a conventional loan. And this property, please note, it can only be used for primary resident. You cannot think that this is a loan down payment. You can use this loan to buy an investment property or second home. FHA does not allow that. It can only be used for primary home. Now, if you have let's say you've bought a home with an FHA loan, and then you want to if you want to move up and buy another home, can you use another FHA loan, given that you already have an FHA with your existing loan? They don't. The answer is yes. Actually, you are allowed. They are allowed to use another FHA loan to buy a move up property if they can show that it's a valid reason that they're moving up, right? Because of job location, or they're buying a bigger property and whatnot. So it can be done. Yeah, and then impounds. It is required. Like with conventional loan, you have a choice of impounding or not impounding, but with FHA, it is required that the client has to impound, so that they have to pay taxes to the escrow company, and then the escrow company in turn would pay tax and insurance on their behalf. And then the FHA loan limit is I want to say overall it's pretty similar to conventional, but there in some counties there are lower. Oh shoot, I should have put this. For example, in San Bernardino or Riverside County, the FHA loan limit is actually below $510,000. I want to say it's about $434,000 in those respective areas. But again, expect those limit to be increasing as well, given the current housing market. So, all right, VA loans. This is another common loan available. This right off the bat, in terms of qualification, there's two types of folks who can qualify for a VA loan: actual veterans, or their surviving spouse of a veteran. Let me repeat: the active actual veterans or the surviving spouse of the veterans are eligible for a VA loan. And some people ask, well, what about fiancés or a girlfriend or significant others? Can they qualify as a co-borrower for a VA loan? The answer is no. The VA are very strict on that. The actual borrower has to have a direct tie with the military in order for them to qualify. So I want to get that out of the way. Now, okay, so let's talk about the requirement. Let's take a look at the requirement. Credit score. Similar to FHA, a good starting point will be 580, but it can be lower. It can be much lower in some instances, below 500 and whatnot. Collateral down payment. This is the biggest benefit of VA, is that there is no down payment requirement needed. You can be literally, in some instances, closing costs will be covered some way somehow, either by the seller or the lender as well. So this is the number one and the most attractive benefit of a VA loan. Capacity in terms of debt to income ratio, it is very lenient. So right now I set it at 50 to 55%, but in some instances, some VA lenders are very aggressive with the income calculation. Some I heard can be as high as 65 or 75% of their income. VA by far has the most generous income requirements. So in terms of the benefit, we talk about 0% down, the low interest rate. there is also no mortgage insurance. Like I'm again to reiterate, in general, if it's any other loan, you put 20% down, chances are there's going to be mortgage insurance. But with VA, there is none. There's no need for a mortgage insurance because veterans, the VA, they are the one basically insuring the loan. They're offering the guarantee to the lenders. So in return, the VA borrower do not have to pay for mortgage insurance. And no loan limits. This is just something that just started this year. It was passed in Congress last year. I believe, shoot, it was last year that there will be no loan limits. So if your clients, hypothetically speaking, they're in San Bernardino, Riverside County, and looking to buy a $600,000 or $700,000 home, the answer is, can they borrow that in that same loan amount? The answer is yes. Yes, they can. But the downside is, like I mentioned before, it's only available for actual veterans and also a surviving spouse. Now, there is a one set of fees that VA has to encounter that other mortgage borrower does not have to involve, and that's the funding fees. This is not a fee charged by the lender. This is a fee directly charged by the veteran that the clients had to be accounted for when they apply for mortgages, and the percentages varies depending on how frequently you use the VA loans. You know, if you're only buying a house for the first time, it's about 2.3%. And in the future, if you buy a second home or move up primary, that funding fee will be increasing as well. But on the flip side, again, it's not really pertaining to you guys, the realtors, but just know this: if a veteran wants to refinance his loan, they would go through a streamlined process, and the funding fee was actually much less. Instead of 2.3%, we're just looking at a 0.5% so far. And then, well, but yeah, that's the characteristics of the VA loan. Any questions so far? Laura, I can't see the chat right now. Can you help me see if there anybody have any questions?
No questions.
No question. Okay, thank you. Yeah, if you guys have any questions, feel free to again raise your hand or put them in the chat. So thanks. All right. Now we talk about some of the major programs, loan programs. I'm going to redirect our conversation into down payment assistance program. This is something that is very beneficial for first-time homebuyers, and there's various form of it. First and foremost, let's discuss what is the definition of being a first-time homebuyer. There's two definitions actually. The first one is the obvious one where Laura, can you mute all? Thank you. All right. So as I was saying, there's two types of definition for down payment first-time home buyers. The first one is the obvious one. It means that they never bought a home before. They're a true first-time home buyer. That's one of the definition. Another definition is simply the prospective home buyer has not been on title of a home for 36 months, 3 years. If they pass that grace period, then they can also be considered a first-time home buyer for the purpose of applying for a down payment assistance program. For the most part, down payment assistance program comes in the form of a second loan, but that's added to the purchase transaction. But it can also come in the form of a grant. I want to say 80 to 90% of the down payment assistance program are loans, but there are some that are grants, which means that the clients do not have to repay, afterwards. Credit score is more strict now. Before it's pretty lenient for down payment assistance program. Before it can be low as 600, but now they have tightened that up a little bit. It is a 660. Collateral down payment, again, it's not needed. Capacity, again, these loan programs typically you add them on to the FHA or VA loan programs. So you just go off of the income requirement by those respective loan. So again, now here's the thing about down payment assistance program. There's two ways to use it. You can use them as down payment, or you can use them as closing costs. Or another option, you can do a combo. If there's sufficient funds available, or a program, these assets available, you can use them for both down payment and closing costs. So just kind of keep that in mind. It does not just have to be used for down payment assistance program. It can be used with conventional FHA or VA loan. And the only downside is that it can only be used for primary home. You cannot use it for investment property. You cannot use it for um, second home and whatnot. It can only be used for a primary home that the clients lived in. Now, if you want to, that's just kind of general overview of the down payment assistance program. If you want to know more about it, you can visit this website, downpaymentresource.com. It's basically like a Wikipedia for down payment assistance programs. If you go to the website, it will ask your clients some basic information, where they live, what their average credit score, what their average income is, and then they will, and where they're looking to buy, and then they will give them a list of a list of available programs for them. So just kind of keep that in mind. So, all right, let's talk about some of the non-traditional programs. Here's another one that's very prominent in the lending industry, and that's the prime jumbo. You're going to come into this loan in Orange, LA County, some of the high cost living areas, which you pretty much, when you have a client that needs to borrow more than $1 million, well, anything over the conventional loan limit, which is 760. But as a general rule of thumb, like, if your client needs $1 million loan, they're talking about a jumbo. Now, the guideline, because this is a portfolio product, this is prime jumbo is not set forth by the government, so the guidelines and interest rate varies amongst various banks. And typically, I'll be frank, these type of loans, couple of things, is before is only available through depository bank, Wells, Chase, Bank of America, and whatnot, or Union Bank. This is actually their niche product. They want to go over the high end folks, and they set their goal as gather the marketplace for this. So those banks will be your go-to lenders. But here's the thing, though. Due to COVID, the jumbo market has somewhat shrink. Because here, let me take some time to explain this. Conventional loan and FHA loan and VA loan, they're backed by government. So in the case when the lenders take on those loans from the consumers, if there are no secondary investors who want to buy those loans, the lenders still have the assurance that they can sell it back to the government and free up their cap space to continue to lend to other borrowers. Now, these jumbo loans does not have the same characteristics. These are backed by private investors. And during this pandemic, it was very difficult for the private investors to price a loan, to assess the risk of these jumbo loans. And as a result, for a short period of time, the investors of these loans just completely back out of the market, which subsequently does not allow these banks to offer these jumbo loans. So now that they're slowly coming back, but still not as readily as available. So in case if you have a client who having a difficult time getting a jumbo loan, just so know that that's one of the reasons is because there's not the requirement is more strict, and simply there's not as much available of these programs in the market. So with that said, let's take a look at some of the characteristics of a jumbo loan. Credit score is much more strict than your other loan that we discussed. At the very least, you need a low 700 to start to have to be qualified for a jumbo loan. Down payment, there are loans that you can put as low as 10% down or 15% down, but in general, for a prime jumbo loan, you need 20% down. Capacity, the debt to income ratio is much more strict. We're not talking about over 50%. We're talking about below 45%. In some instances, it's below 40%. The pros, well, that used to be, I won't say that used to be the case. It has a lower interest rate, a conventional loan, but now that's not necessarily the case anymore. At least a short time being, that actually slightly higher interest rate. It's still pretty good compared to the last few years. If you compare year to year, it has a lower interest rate, but compared to conventional loan or FHA loan, it actually has a higher interest rate. But again, regardless, we're talking about a larger loan amount. Is a privatized investment property, which means stricter guidelines. There will be reserve requirement, meaning that for your clients, in addition to having down payment and closing costs, they need to have additional savings set aside to meet the reserve requirement. And yeah, again, right now, just not as available. Not even Not all lenders offer this jumbo loans at this point, but again, it doesn't hurt to kind of ask around. So, all right. So there are other. What happened when your client doesn't qualify, doesn't meet the requirement for any of those loans we talked about, the conventional loan, FHA or VA loan or jumbo loan? Does that mean that they automatically can't buy a home anymore? They don't qualify for any loan? No, that's not necessarily true. There are a smaller niche market that want to stretch their guidelines or their requirement to take on these clients because when it comes to qualification, it's not really absolute. It's not like you either absolutely qualify or you don't. There are some in between gray area where investors and lenders with common sense think, hey, they just barely missed out on those traditional loan program we talk about, but they should. Common sense said that if they have enough other requirement or qualification, they should qualify for a loan. So that's what the next group of loan I'm going to talk about kind of comes in. They call the non-qualifying loan programs. Basically, these are programs with more generous guidelines than the loan programs that I discussed. But right now, though, the availability of this program is very similar to jumbo in that, again, these loan programs are not backed by the government. If a lender originate these loans, they need to have investors they can sell to in the back end. And for a brief period of time, the investor of these loans, just like jumbo, they don't know how to assess the risk and does price out these loans accordingly. So a lot of them, they just backed out. They completely left the market. So I want to say from April until September or October of this year, these programs hardly existed at all. But now that we're in a more stable market, the investors are slowly coming back, and these are programs that become readily available again. So it's a good idea for you guys to kind of be aware of these loan programs, so that in case one of your buyers they don't qualify for a traditional loan, know that they still have an option to potentially qualify as well. So let's take a look. The 2 of the 3 C's we talked about, so before I talk about they need to have good income, good credit, enough assets, all of that. They need all of them in order to qualify, right? With these loans, that's not necessarily the case. You generally just need meet 2 out of the 3 requirement, and there's a good chance that they can still qualify for a loan. So let's take a look at the standard non-qualified mortgage loan. Simply put, every part of the guideline for this loan is a bit more lenient than the loan we discussed. So in terms of credit, I just put it as low because it could be as low as 500. In some instances, it could be as low as high 400s. It is very lenient, very generous with the credit score requirement. Collateral, you don't necessarily need the 20% down. You can put less than 20%, 15, 10% down. Not as low as FHA, where you can still put a low down payment. The capacity, the debt to income ratio, much more lenient than a conventional loan. So yeah, again, I just reiterate, in terms of guideline, is much more lenient than a conventional loan. Now, on the flip side, guideline leniency means risk for the investor. And the way that lender get compensated for the risk is a higher fees and interest rate. So when your client is considering these loans, set the good expectation, in that you can qualify for these non-qualifying mortgage loan, but don't expect the same interest rate as the conventional or FHA loan. It will be higher. It's going to come with a higher interest rate. It'll come with higher fees. They're just something they have to bear in mind. But one way to get around this, if your client is hesitant to take on this loan, one thing you can convince them is that, hey, find out what their immediate income situation is going to be like in the next year or 2. If there's a legitimate chance that they can improve their income, you can convince them the fact that take on this loan as a short-term solution to buy the home. And once their income situation or financial situation improve, then they're more than welcome to refinance into a conventional loan. So you can also, a lot of clients with that kind of mindset, they use this as like a temporary loan, just to have the opportunity to buy the loan and then refinance out of it once their financial situation improve. Next, we have the stated income loan. This one, the availability for this loan definitely has shrunk because this is a very risky loan for the lenders. When I say stated, literally, the lender does not look at tax returns, pay stubs, W-2s and whatnot. They simply have the employer fill out the employment verification to verify the client is working. And that pretty much is the extent of employment verification. In terms of credit score, it's very relatively generous. You need at least a mid 600 to qualify. It does require a lot more down payment. I started off 20, but to be safe, nowadays lender I bump up that requirement up to 30%. So just know that you don't expect a low down payment for a stated income loan. There's also reserve required. It could be anywhere to, yeah, like I said, it could be as general as 6 months or actually excuse me, as extensive as a 5 years reserve worth of reserves. Capacity, because it's stated income, so this shouldn't be an issue. Like I said, the only employment verification is that they will be reaching out to the employer and verify that the client is working for the respective company. But yeah, here's the thing you want to be mindful for. The biggest employment verification that the lender will be looking for is the validity of the employment. They want to make sure this is a true, legitimate company and that the company is still in operation. So a lot of instance with these stated income, the lenders might not be asking to verify the borrower's income, but they might be asking the company or the business, the employer, to provide their income verification to make sure that they're still in operation. So just kind of keep that in mind. It's not easy, it's just easier versus conventional loan. So don't think of this as no, you don't have to provide income verification. There's still, there's still verification involved. Again, it's easier qualification, but again, leniency means risk. Risk means higher interest rate. A higher interest rate, higher fees, reserve required. There's no get around it with these type of loans. So there's another loan. You can consider it a semi-stated loan, but it's called a bank statement loan. Let's say if you have a self-employed borrower, they make great deal of income through the business, but to eliminate or reduce their tax liabilities, they purposely take on a lot of deduction. So there's a drastic difference between how much it actually make versus how much they report, right? Specifically in those instances for self-employed borrowers, a good alternative for them to apply for a loan is a bank statement loan. The credit score is very lenient. The down payment is low. And in terms of bank statement, how that is used to verify the income is the lender would look at the average monthly bank statement deposit. It could be as short as 6 months. It could go up to 24 months. They will look at the average deposits and then use that average deposit as a quote unquote qualifying income. So again, that kind of suits the self-employer who makes good income but doesn't report it in terms of tax purposes as much. There's one additional requirement to that is nowadays bank statement lenders, they not only want to see a 24 month average, they want to see your last 2 to 3 months of bank statement to ensure that your business is still in operation. Because sadly, due to the current pandemic, a lot of folks who cannot continue operating the business as the way as it's done before, so their income has been drastically affected. But in those folks in this situation, sadly, it might be a challenge for them to get the mortgage because lenders will be asking for the latest bank deposit as a way to verify income. If they cannot provide that, they won't be able to qualify. But again, so with that said, overall, though, this is an easier qualification process versus a conventional loan. But again, leniency equals higher interest rate and fees. So kind of keep that in mind as well. And then lastly, this program is meant for investors. If you work with investment homeowners or if you work with flippers, this could be an ideal option for them if they don't want to pay mortgages with cash. And that's the proverbial private hard money loan. In many of these instances, they don't really care about your credit score as long as you have the down payment. Starting at 20%, but just to be safe, most of them will probably require 30% down payment. In terms of income, they don't really care. As long as you have the down payment, it's good enough for them. It's extremely easy to qualify and very fast to close. You can close it in about, let's say you can close about actually in less than 10 days. A lot of lenders, again, they just want to make sure that the value of the property is there and then they can fund the loan right away. So on average, the closing of a private loan, it could be anywhere from because there's not much need. You don't need to season the funds. As long as you have the funds, the property value is there, they can fund the loan. The flip side is it's like the opposite of FHA loan, right? You cannot use this for primary home. It is only used for investment purposes because technically by law, this is a business loan. This is a business loan, so it cannot be used for primary home purposes. These type of loan comes in very high interest rate. We're talking, just generally speaking, about double figures, 10% or higher. And then it comes with high fees as well. You can expect about, just even to be generous, about 2 to 3% of the loan amount. And then the terms of these loans are much shorter. All the previous loan we talked about, you're talking about a 30-year fix, or maybe 20 or 15, whatnot. But generally, we're talking about 30-year fixed rate loan. These type of loans are extremely short term. It can be anywhere from 6 months or just like 1 or 2 years. Most of the time, though, these loans are only offering interest-only payment as a monthly basis. But when it's time that these mortgages are due, you have to pay the lump sum up in the designated period, whether it's a 1 year or 2 years down the line. But again, for flippers, this could be an ideal situation. If they can find a property that can, flip for a high margin in a short period of time, in those instances, it might be worth the while for the investor to take on these hard money loans and get an ROI from flipping the property. So, yeah. So that's the quick guidelines of all the mortgage programs currently available, depending on what type of buyer you encounter. And that's pretty much it. I know I try to save some time for Q&A, but this is my first time doing this Zoom, so there's less interaction as well. So we kind of blitz through this pretty quickly. Just kind of reiterate, we kind of talk about the loan process, what you as a realtor can expect during the process. We talked about the various loan program. Hopefully, it gives you a general picture of kind of advising your clients what program they should be on the lookout for, depending on what their needs are. And especially, like, my one final advice for you realtors out there is you gotta plan ahead. Like, if your clients see a property that they like, chances are you're in a multi-offer, counter-offer bidding war. And again, does getting pre-approved you automatically wins you the deal? No, but it just increase your likelihood. You're showcasing the buyer like, hey, not only are we making attractive offers in terms of the pricing side, we are prepared on the lending side to then make sure that we can close on time. So I just now more so than ever in this competitive market, before you even show your take clients out showing, you want to make sure they're pre-approved, not pre-qualified, pre-approved, have all the documents prepared, because by the time ready to submit offer, it is almost guaranteed that the listing agent want to see those qualifications before considering your offer and going through a counter offer. So that's my one last advice. And with that, I am done with my presentations, and I'm just kind of throwing back to you guys to see if you guys have any questions about our boot camp today.
I don't see any questions as of yet.
Okay. Here's what I'll do though. Some of you or none of you asked for it, but a lot of times attendees will ask for the copy of the PowerPoint. What I can do is I can send a copy to Laura, and then if you guys want, and then she can forward to you guys, and then and then you have any questions, you can reach out to me about it, and then also just these PowerPoint just used for your own personal benefit when you meet your clients in the future. So
Great. Thank you, Eric.
No problem with that.
Good job.
Yep, I'm done with the class, and thank you all for attending today.
Okay, bye.
Okay, bye everybody.